Stan, good to see you again.
Hi, Tyler. I don't see you, but I'm happy to hear you.
That's all right. You just listen intently here, and I get to see you. Let's talk about why you think the markets got it wrong on the origins of this inflation and on who the solution providers should be and what the solutions should be. Give us the kernel of the argument.
So I'm not sure that markets have it wrong necessarily. There's no question that there's inflation, but I think that the analysis is incomplete and the Fed is the wrong problem solver. Milton Friedman famously said, inflation is always a monetary phenomenon, except when that's not all it is, which is right now. This is pandemic pent-up real demand, okay, times synthetic free money demand, times politically disrupted supply. Normally, the tools that the Fed has is they raise interest rates to cool off excess demand. I don't believe that we have fundamentally excess demand, actually on the contrary. And what we do have is politically disrupted supply. Supply that's been disrupted by first Trump's trade war, and now, of course, the European war and Putin's, brutality in Ukraine.
And
so
also, would you include there, Dan, the disruptions caused largely in China by COVID and the lockdowns that are there now and what they had to do in the past?
Right. So my view is that inflation will resolve itself when it resolves itself. If you can tell me when policymakers are going to come up with the right policies to help the supply chain shortages and disruptions, then we can give you a date. But raising interest rates right now is not a thing. Corporates should be and are taking steps on their own because they have economic incentives, not political incentives, to repair their own supply chains as best that they can under the circumstances. And I believe that we need to move policy back toward free trade and establishing the basis for free trade.
And you also believe, if I'm understanding correctly, that by raising interest rates and withdrawing money through quantitative tightening, not only will you have higher rates and higher carrying costs on an already enormous federal debt, but you will be hastening and deepening what you see as a likely recession to affect not just the United States, but Europe and many parts of the world.
Exactly. That was laid out in the article that I published, late last week. I think we need to remember that we are still, despite the episodic inflation, which I would call event-driven inflation, we are still in a disinflationary, long-term secular environment characterized by spiraling debt, aging demographics, and above all, disruptive job-displacing technology, which is basically going to be de-employing not only blue-collar workers, but already is de-employing skilled workers, many of whose tasks can be replicated by AI that isn't necessarily particularly intelligent.